Hello, welcome, namaste. In today's video, I am analyzing Crisil Limited. Crisil is a credit rating agency. Let us look at the company's profile first. Beginning with the segmental revenue analysis, the company has basically three different sections from where it generates revenue. It has a rating services, research services, and advisory services. The research services gives it the maximum revenue of around 60%. Rating services gives it around 32% of the revenue in 2019, whereas advisory services contributes a small portion of around 8%. If we compare this with 2018, the rating services contribution to the revenue has increased from 29% to 32%. If you look at in terms of revenue, how much it received from which section of its businesses, rating services contributed around 544 crores, research services contributed around 1044 crores, which was a drop of around 6% from 2018, and advisory services contributed around 142 crores, which was a gain of around 5% from 2018. If we look at the profit, rating services contributed around 19% more in terms of profits in 2019 at 219 crores. Research services has seen a fall in its contribution to the net profit at 233 crores compared to 326 crores in 2018, and advisory services has gained around 12 crores compared to 8 crores of losses in 2018. Next, let us look at from which geography these revenues are coming into the business. So, of the total revenue for the year ended December 31st, 2019, exports contributed 67% and domestic services contributed around 33%. So, most of its revenue is generated through exports. India contributed around 574 crores to the total business. Europe contributed around 447. North America contributed around 544, and the rest of the world gave around 164 crores in terms of revenue to the company. So both India and North America are contributing a substantial portion to the company's overall revenue. Let us look at the income trend and then PBT trend. We can see a gradual uprise in the income from operations over the years from 2010 to 2019 in a very gradual manner. In the same manner, the profit before tax has gone up from 288 crores to 528 crores in 2019. If you look at the profit after tax and market capitalization, the profit after tax also has increased from 165 crores to 344 crores in 2019. So there is a growth in the profits over the years. Market capitalization as of 2019 stood at around 13,793 crores. This is the value of the company in the market as of March 2019. And in 2010, it started with a market capitalization of 4,200 crores. Since then, it has grown substantially. The net worth per share, that is the book value per share, in 2019 stood at 162 rupees compared to 2010, where the book value per share was around 55. So we can see that the company has managed to gain book value per share over the years. Income per employee in 2010 was 25 lakh rupees per employee, which has now increased to 46 lakhs per employee in 2019. So the company is efficient in generating higher and higher returns from each employee. Return on average net worth or return on average equity has seen a slight drop to 30%. Even this is substantially higher, and we should look for above 15% of return on equity. The maximum return on equity was generated in 2011 at 50% of the net worth. That is, on the net worth, it generated 50% profits. Let us look at the key ratios. Of these, I'll concentrate on 2019 and 2018 and also look at certain ratios only. Looking at the third line, operating profit margin stood at around 29% in 2019 and 30% in 2018, and the trend is very nearby throughout the years. Depreciation is occupying a small portion of the total revenue. Final net profit margin of 2019 stood at around 19% compared to 20% in 2018 and has been around this value for many years. Debtors turnover ratio, that is against the amount of debtors, how much was the sales, stood at around 6 times. That is, its revenue generated from the business was 6 times higher than the amount it has to collect from its customers, and this it has kept at a stable rate. Current ratio is very comfortable at 2 times throughout the years. Operating profit margin, which we saw earlier, stood at around 26%, whereas net profit margin stood at around 19%. The return on net worth is high at around 30%. So the company's numbers are very good. This was a quick analysis of the company's profile and a few ratios. Let's move on and look in detail as to what the company does and its business model. Let us begin with the detailed analysis of Crisil Limited, and next we'll look at the company's financial statements along with the peer group analysis, and finally we will end it by looking at the graph as well as intrinsic value calculation. Beginning with the company's detailed profile, Crisil is a leading global analytics company. It is India's foremost provider of ratings, data, research, analytics and solutions to corporates, financial markets and the economy at large. Crisil's businesses operate from India, US, UK, Argentina, Poland, China, Singapore and the UAE. It is majority owned by S&P Global. Certain issuers, especially non-banks and housing finance companies with wholesale lending model, continue to face resource raising challenges. Going forward, muted private expenditure combined with slowing domestic and export demand are likely to constrain wholesale credit demand. This is a negative because as the economy slows down, the credit demand and thus the work for credit rating agencies would slow down. Besides sluggish demand for wholesale bank credit, the BLR, that is the bank loan ratings market, remains affected by the guidance from several large banks, increasing the minimum threshold exposure that would require a bank loan rating. This is also a negative. What has happened is many of the banks have increased their minimum threshold exposure because now that minimum exposure has been raised, they don't need to go for a rating. They don't need to apply for a rating from a credit rating agency. And banks also don't demand any rating reports from these borrowers as the minimum exposure limit has been raised for availing credit. The securitization market, that is the conversion of an asset, especially a loan, into marketable securities, typical for the purpose of raising cash by selling them to other investors, continues to see buoyant issuances on the back of investor preference for securitization in a cautious environment. This is a positive as more and more investors who want to buy into the securitization market would want those assets to be rated so that they can purchase it. New client acquisitions, healthy traction in securitization and independent credit evaluation of stressed assets maintained Crisil's market leadership in 2019. As many as 2,200 new bank loan ratings and over 7,500 SME gradings and assessments were assigned in the year. Crisil Ratings initiated development of a new platform and enhanced the existing technology platform in 2019, which would further enhance operational effectiveness and regulatory compliance. To mitigate the risk arising from high dependence on any one business for revenues, the company has adopted the strategy of diversifying into new products and services and different business segments. To address the risk of dependence on a few large clients and a few sectors in the business segments, the company has also actively sought to diversify its client base and industry segments. The company strives to add value to its clients by providing services of superior quality, introducing relevant tools, platforms, and products to mitigate the risk arising from slowdown in global economy and competitive pricing. Repeat business from large clients in the research segment nevertheless continues to contribute significantly to the revenue. Crisil foreign currency revenue earnings are significant, and any appreciation or depreciation in the rupee can have a significant impact on revenue and profitability. The company has in place a well-defined foreign exchange management policy. In the past 2 to 3 years, SEBI, the regulator for credit rating agencies in India, has issued guidelines to mandate more disclosures by credit rating agencies, ensure greater discipline in the rating processes, and set enhanced norms for functioning of rating committees. SEBI has also raised the bar on the eligibility to set up a credit rating agency and stipulated greater disclosures for issuers on their financial performance. Overall, the revisions in guidelines will improve transparency of the credit rating process and enhance standards of the CRA industry. At the same time, the recent guidelines increase the operational intensity of the rating process. Crisil continues to focus on leveraging technology to build appropriate controls and monitoring tools for safeguarding the rating process and facilitating necessary disclosures. So this completes my detailed analysis of Crisil. Let's move on and look at the financial statements. Let's begin our analysis of Crisil Limited by checking out the profit and loss account. The sales has been growing over 3 years in a compounded manner at the rate of 6.68 and 3.82% for both 5 and 3 years. There has been a growth, but in a lower single digit, whereas from December 19 to the recent 12 months, the sales seems to be very flat. So we want the sales to be growing over the long term period as well as in the recent 12 months. So it has grown only at around 0.69%, which is quite flat considering that the sales has to consistently grow over a period of time, because that is where the revenue is generated for the company. Opm margin for Crisil has been quite high over the 5 and 3 years period of about 25%, because this company generally gives service and therefore their operating expenses are very low. In December 19, the expenses were around 1,276 CR against the total revenue of around 1,732 crores. That's a 26.3% of OPM. Whereas even in the recent 12 months, the OPM margin was quite high at about 25%. Other income has been contributing around 6.3% at around 111 crores and has been growing gradually. This happens due to their investments increasing over the years. The depreciation as a percentage of total sales is very low at around 3.1%, and that is understood because this company would not have a lot of assets and therefore the depreciation value would be also very low. Raw material cost would be zero and employee cost is almost 50% of the sales. So the company is spending a lot of revenue on its employees and almost occupying 50% of its total sales. Interest expense is very low, and this signifies that the company is in a debt-free position. Tax rate in the recent 12 months stands at around 28.3% compared to December 19 where it paid 30% as tax. The value of the tax paid is also very flat, as well as the PBT that it has been earning over 16, 19 and the recent 12 months. Interest coverage would be quite high. As we know, the company is debt-free, so their interest burden is also very low. In the recent 12 months, it paid around 4 crores on a total EBIT of around 500 crores. So therefore, their coverage ratio would be very high. Net profit margin throughout December 16, 19 and the recent 12 months have been above 15%, whereas in the recent 12 months, it has gone more than 20%. So it has earned around 355 crores of profits on a total revenue or sales of around 1,744. So these are good values. Average NPM throughout also has been very high at about 20% in the recent 12 months compared to its average of the last 3 years at around 19.7. If we look at the growth in profits, here too we see a lower single digit growth rate in profits throughout the years, from December 14 to 19 at around 5.1%, whereas in the recent 3 years at the rate of around 5.3. Whereas from December 19 to the recent 12 months, that is 1 year, the growth has been at around 3.3% absolute. So we see both sales and profits have been growing, but at a lower single digit. In the recent 12 month or the latest market cap is at around 10,173 crores. This is the value of the company in the market, against which it did a sales of around 1,744 crores in the recent 12 months, which is basically around 5.8 times higher. So the market cap is currently available at around 5.8 times and way below where it was trading in December 19 at around 8 times and December 16 at around 10.2 times. So its valuation in the market has dropped from 15,700 crores in December 16 to around 10,173 crores in the recent 12 months. So we can see that overall the market cap has been falling because there is no growth in the sales over the years, and therefore the market cap is bound to fall down, and currently it is available at around 5.8 times its sales. The dividend payout throughout the years has been above 50%, and the company believes in paying out a substantial portion of its profits as dividend to the shareholders. So we can see in December 19, out of the profits of around 344 crores, 231 CR was distributed as dividend. So this is a very high dividend paying company. The current price earning stands at around 28.7 times. On a total price of around 1,400, the company is earning around 49 rupees of profits, which is a multiple of around 28.7 times. That is, we are paying for a profit of around 49 rupees, a price of 1,400. So this is slightly expensive. I would want to buy when the price to earning falls below 25 times. In December 19, 1 year back, it was trading at around 40, whereas in December 16 it was even higher at around 53 times. This was not the right time to buy into this company. Even in December 19, we have to avoid buying into this company. This company follows the calendar year of reporting, and so therefore we don't have the March values. Instead we look at the December ending values. As of date, that is 25th April 2020, it is available at around 28.7 times. We still have to wait a little bit more for it to fall below 25. At least I would wait, because that's my benchmark. If we look at the average price earning, it is currently at 28.7 and way below its 5 and 3 years average price earning multiple. Although if we look at the averages, it is quite below that, but we still have to check this price earning multiple with the profit growth as well as with its peer group companies. Moving on to the balance sheet analysis, the share capital has never been diluted. It stands from December 14 till December 19 at around 7 crores, whereas the face value is at 1. Return on equity throughout the years have been about 25%. So on a total net worth or shareholders contribution in the business, which has been steadily rising if we observe, at around 1,172 crores, on that the company has made a profit of around 344 crores. So that profit itself has been gradually increasing throughout the years, as well as the amount of shareholders contribution in the business is going up. The return on equity on an average basis, if we look at 5 years, that stands at around 30.7%, and even the current 3 years is at around 30.1. So company has managed to keep its 5 years, 3 years average ROE above 30%. This data, for your information, has been sourced from screener.in. Return on capital employed measures how much total capital was employed into the business, and on that total capital employed, how much was the profit or top line profit the company generated, which is also known as EBIT, earnings before interest and tax. In December 19, the overall ROCE values, actually if we look at all the years, it has always been above 40% of return on capital employed, a very high value, and this shows efficiency of the company. On the total capital employed, it's managed to earn an EBIT of around 492 CR, a high ROCE value. Let's look at the last 7 years, 5 years and 3 years trend, and here too we see above 40% throughout the last 7 years, 5 years also and 3 years also. Return on assets also over the years have been very high at about 20%. So the total balance sheet size was around 1,700 CR. On that, the company's net profit stood at around 344 CR, which is around 20.2%. And throughout the years also we see a high above 20% of profits generated on the total balance sheet size. The company is debt free. As of December 19, the debt stood at only 3 CR against the total equity base of 1,172 crores. Equity is contributing around 69% to the total balance sheet size. Out of the total balance sheet size of 1,705 CR, 1,172 is shareholders' contribution, whereas 3 CR is from debt and the balance is from other liabilities. The current market price to book ratio stands at around 8.7 times, a very high and expensive multiple. My benchmark to buy in terms of valuation is below 2.5. In the recent 12 months, on a total market cap of around 10,173 crores, the amount of net worth or equity shareholders contribution in the business stood at around 1,172 crores, which is a value of December 19, and therefore a very high multiple. I would not want to buy into this company until and unless I see a very attractive valuation or I compare it with its peer group companies. Even if we compare this with its past data, it was very expensive. In December 16, it was available at 15.9. From there, it dropped to 11.8, and now it is at 8.7. So we have to compare the valuation and then only buy. Looking at the valuation of a company and buying is very important. We cannot buy at any price or at a high price. It won't allow us to earn a substantial profit. The higher we buy, the more we will have to wait to gain profit. And if the price drops, then we'll get frustrated if we buy at a higher price. So better to wait patiently and then buy at a good lower valuation or multiple. Because the company is debt free, the debt to net profit ratio would be hardly anything. Debt is just 1% of the total net profit of 2019. Let's check out the net block percentage, that is, what is the net fixed assets of the company of the total balance sheet size. So company's assets were at around 349 crores, which is around 20% of the total assets. And earlier when we analyzed the profit and loss account, there we saw the depreciation that was deducted from the P&L account was around 37 crores. Here on the right hand side we can see. So on a total assets of around 349 crores, 37 crores was deducted. The company is reasonably deducting depreciation over the years. The asset base has not increased substantially from December 16 to December 19. Net block is basically the assets of the company that is shown in the balance sheet as of December 2019 after removing depreciation from it. So if we look at before depreciation, before removing depreciation from the assets, before deducting depreciation from the assets, would be the gross block. So gross block stood at around 386 crores as of December 19. These are the total assets of the company before depreciation was deducted. So what we do is we add the net block 349 crores, this is the fixed assets, 349 crores, and add 37 crores back into it. So we get around 386 crores. So on a 386 crores, the company depreciated around 37 crores. That works out to around 9.6%. So this is the value at which it is deducting or reducing the value of its assets and transferring it as expense to the profit and loss account. The reason for analyzing the net block percentage and depreciation is to understand if the company is doing any kind of manipulation in terms of how much depreciation or how fast or slow it is deducting depreciation on its fixed assets. Capital work in progress, this is the amount of work going on in terms of building fixed assets for the company. So it stood at a very small 12 crores of fixed assets being developed as at end of December 2019, which is a mere 0.7%. The company's cash holding has been increasing throughout the years and now it stands at around 346 crores, which is occupying almost 20% of the total assets. This is not a bad value. We don't want it to exceed 30% of the total balance sheet size. Too much of cash holding means that the company is not investing it properly in terms of either putting it into mutual funds or generating other income for the business. Instead of cash holding, it should put it back either into growing its business through acquisition or pay it off as dividend or invest it in a or invest it into something which would generate a source of other income for the company. Investments percentage stood at around 26.6%, which is like 453 crores of investments. So company has a substantial cash holding as well as investment holding in its balance sheet. Out of the 1705 crores, 453 crores were invested into mutual funds or investing activity other than fixed assets. So this particular investment would generate other income for the company. In December 16 also it stood at around 465 crores. So percentage wise, if we see, there is a slight drop at around 26.6, and this is good. We don't want a very heavy investment until and unless the company has no growth plans or does not require substantial money as cash holding. Debtors stood at only around 11.7% as of December 19 on its total balance sheet size. Debtors are those people or those customers from whom the company has to collect payment for services given. As of December 2019, the company had to collect around 199 crores from its customers, which stood at around 11.7%. This should not exceed more than 30% of the total assets. We don't want a lot of payment pending to be collected from customers. In terms of comparing the debtors with sales, we see that as of December 19, 199 CR was pending to be collected from the customers on a total sales at the end of December 19 at around 1732 crores, which is just 12%. Even if you look at the past data, it was very nearby to this percentage. The company is keeping its debtors at a reasonable level throughout the years. In December 19, it took around 42 days to collect payment from the customers, which has substantially reduced from December 16 value of 49 days. So the faster it collects payment from the customers, the more efficient it is considered. Current ratio throughout the years have been above 1 times. In December 19, on a total asset base of 891 crores, company's current liabilities were around 530 crores, which is 1.7 times multiple. So it has enough assets to pay off the current liabilities or those liabilities which will arise in the current year. Company wouldn't have any inventory holding, as well as inventory turnover will be also zero, because the company is into service business and therefore would not be holding any inventory. Moving on to the cash flow statement analysis. This is a very important analysis, and this needs to be checked to see if the company is receiving cash against the profit declared by it. In December 19, company received 30% more cash. That is, it received 30% higher cash flow from operating activity than the profit declared. In December 16, there was a slight shortfall in terms of cash received against the profit declared, but this is also very minor. But I would want the cash inflows to be higher than the profit shown in the profit and loss account. Even in December 14, the cash earned and the profit declared were very nearby each other. Let us look at the long-term trend of 7, 5 and 3 years and see how the net profit and cash flow operations played with each other. In the last 3 years, we see a higher inflows of cash at around 1,115 crores against 1,000 crores of net profit. All of these ratios are very important to look at. Each and every ratio that I have analyzed is to understand if there are potential problems or red flags, which would then help us to avoid investing in this company. In the last 3 years, the company's cash inflows were 10% higher than the net profit declared. In 5 years, if you look total, it earned around 1,664 crores of net cash from operations. This is the total cash it earned in these last 5 years against the profit of 1,591 crores. So this is a very important value to look at in the long-term trend of 5 and 3 years. We do want to see that the company is receiving cash against whatever profit it is showing in the P&L account. Next, we'll look at how much was put into investing activity out of the cash it earned through the operating activity. In December 19, 17% of the cash earned was invested back into investing activity. That is investment in fixed assets as well as investments in mutual funds, shares, etc. In December 16, it was a very small amount of investments at around 7%. In December 14, almost 70% of the cash earned was put into investing activity. But we have to look at the long-term trend and see if that is stable. Here we don't want the companies to, at least I don't want the companies to invest more than 50% of the cash earned from operating activity into investing part, until and unless if there is no growth, as I explained earlier, it can put it into investing activity, that is buying of mutual funds, shares, etc., or fixed assets also to grow. So every ratio is connected with one another, and the balance sheet is connected with profit and loss. The profit and loss is connected with the cash flow statement, and so on. So we have to cross compare everything with, if I am looking at the investing part, so this is connected with the balance sheet, and so on. So throughout the years we see that the company never invested more than 50% of total cash earned into investing activity. So this is a good value over a long term period. The cash profit margin compares the sales with the operating cash flow of each year. Earlier we saw the net profit margin where the sales was compared with the net profit of the company. Here when we look at the cash profit margin of December 19, it stood above 25%. So the company earned a 446 crores of total cash from operations on a total sales of 1732 crores. December 14 and December 16 also was above 15% of cash profit margin. So the company has been receiving a substantial cash profits in its cash flow statements, and this is a good part. Let us look at where the current price is compared to where it was 3 years back, 5 years back, and 7 years back. From 3 years back, the price has fallen substantially. The absolute fall is at around 36.1%. This is the direct fall from 2,200 rupees per share to 1,400. Whereas on a CAGR basis, that is every year, the fall in this last 3 years from December 16 to the current market price is at around 13.9% of fall every year. If you look at pure price valuation wise, then we are getting it at around 36% lower than where it stood in December 16. From 5 years back, from December 14, we have seen a total 25.9% drop. So we are getting it cheaper from where it was available in December 14. So the current market price has fallen even below the price of December 14. CAGR, it has dropped around 5.8% in the last 5 years. Every year the fall is of 5.8%. If you don't understand any ratio, do let me know in the comment section and I'll try to explain it further in my next video or even in the comment section itself. But do thoroughly understand each ratio. Each ratio is very important. If you look at from 7 years viewpoint, the current market price is above the December 12 value. It has grown at the rate of around 3.8% CAGR over the last 7 years. That is, every year it has compounded at the rate of 3.8%. And on an absolute basis, if somebody had invested in December 12 and held till the current market price, you would have expected your price to gain only by around 30% in the last 7 years. So if we want to understand valuation wise where the price is, then it is quite reasonable. But when we observed earlier in the balance sheet price to book, even price to earnings, we saw that these valuation ratios were quite high, and we have to again wait for it to fall further to buy at a good multiple or a good valuation. We'll also look at the graph and see where the RSI level is, where the relative strength index level is, to understand if the company is cheaper right now or is it still expensive in terms of technical analysis. So at least fundamentally, when we looked at the price book, price earning, even market cap to sales, it was quite expensive. And I'll wait for these valuation ratios to come down at my comfort level before I can start buying into it. I don't rush into buying any scripts until and unless these are very good and high valued companies. But nonetheless, even if the company is very good, I would still wait for the technical level, that is the RSI level, to fall below 30 for me to start buying. So at least price wise, the current market price has fallen below its 14 and December 16 values. Finally, let's recap the valuation ratios. Price to earning is high at around 28.7 times. Although price to cash wise, we are getting it below 25 at 22.8 times. Price to book is also very expensive at 8.7, and market cap to sales is also expensive at around 5.9 times. So at least when I'm looking at the valuation wise, I'll still need to wait for some more time before I can think of buying into this company. I've taken up this analysis to show that we can at least keep our companies shortlisted based on the fundamentals, and whenever the opportunity presents, we can buy at that time, so that we don't need to analyze whenever that opportunity presents itself. Alternatively, we can also look at its peer group and see if any other companies are giving us opportunity to buy into them. Let us move on to analyzing the quarterly P&L account. From December 19 to March 20, revenue has seen a fall of around 7.9%, whereas from 1 year back, that is March 19 to March 20, it has seen a 2.9% gain. So the result here, at least in the quarterly analysis, is up to date till March 2020. Profits have grown at the rate of around 15%, whereas sales have grown at the rate of 2.9% YOY. From December 19 to March 20, quarter on quarter, both the sales as well as the profits have seen around more than 7% of fall. Net profit margin, even though there is a degrowth in both the profits and sales, it has maintained a margin of about 20% in March 2020 quarter. If you look at the March 19 and December 19 values, it is very nearby to around 20%. So overall, I see a good fundamental in this company, and I would want to buy into this provided the valuations come down further, that is, the price falls down further. I would wait for the prices to fall down further so that I can buy into the company and the valuations come to my benchmark. So this completes my detailed analysis of the financial statements of Crisil Limited. Let's look at the peer group analysis. In the peer group comparison, I am comparing Crisil with ICRA and CARE ratings. The current market price for Crisil is 1,400, ICRA is at around 2,100, and CARE rating at 393. The highest fall from its 52-week price was for CARE ratings at 61%. ICRA and Crisil both have fallen at slightly less than 35%. Result for Crisil is up to date till March 2020, whereas CARE ratings and ICRA's results are up to date only up till December 2019. If you look at the sales growth over the quarter YOY, both ICRA and CARE have seen a degrowth in their overall revenue from December 18 to December 19, whereas Crisil has seen a slight growth from March 19 to March 2020. Net profit YOY, again Crisil has seen a growth of around 15%, whereas ICRA has seen a degrowth of around 16%, whereas CARE ratings has seen a fall of around 43% from 1 year ago period. Sales, if we look for the entire year of 2019 and compare it with the recent 12 months, Crisil's sales has been almost flat at around 2019's value. ICRA is also very nearby to its 2019 value, whereas CARE rating has seen a substantial drop in its overall revenue from 319 crores in 2019 to 267 crores in the recent 12 months. Next, we'll compare the profit of 2019 with the recent 12 months. Crisil has seen a slight growth in its profit for the entire 12 months. ICRA has seen a slight degrowth from 104 to 87 crores, whereas CARE ratings has also seen a degrowth from 137 to 104 crores. We'll look at the profit after tax of 2019 and compare that with cash flow from operating activity, that is how much cash it received against the profit declared. Crisil had shown a profit of 337 crores in 2019, and against that it has received a cash of 446 crores. So it has received more cash than what it showed as profit. Whereas ICRA and CARE ratings both have received less cash than their profits declared. Valuation wise, that is price to earning, CARE rating is trading at around 11 times its earnings, the lowest in the group, and Crisil is quoting at around 28.8 times its earnings. ICRA is going for around 23.8 times. So the higher the multiple, the more expensive it is. but it does not mean that the lower price earning multiple means it's a good stock. It's just valuation wise it is low. Looking at the current market price to the operating cash flow, Crisil is quoting at around 23 times its operating cash flow, ICRA at around 25 and CAD ratings at around 10, the lowest multiple for CAD rating. But we'll have to understand why the company's valuations are so low compared to its peer group companies, whereas Crisil is trading at a high premium in price to OCF, although it is below 25 times, which is my benchmark. Price to book value is very expensive for Crisil at 8.7 times, whereas ICRA is above my benchmark of 2.5 and CAD rating seems reasonable in terms of price to book at 2.1. But we will understand as we go down why this company is trading at such a low multiple. PEG wise for 5 years, Crisil is going at 5.5, ICRA at 2 and CAD rating at 3.3. So the most reasonable or economical in terms of price to earning and profit growth of the 5 years is ICRA at 2. Crisil seems to be a bit expensive in terms of PEG because although we are paying 28.8 times its earnings, that earnings is not having a good growth over the last 5 and 3 years. So the profits are growing only at 5.3 and 6.8% compared to the multiple that we are paying for that earning. So as we pay higher multiple for the earnings, we also want to see a higher growth or historical growth in that earnings. So even though CAD ratings price earning multiple is low at 11.2 times, we don't see a high growth in its profits. So even this low multiple of 11.2 is not justified because we don't see a corresponding growth in the profits for both 5 and 3 years. I would want the PEG ratios for my companies that I am investing in to be below 1.5. The PEG is calculated by dividing the price earning with the profit growth rate of either 5 years or 3 years. Let us look at the growth in sales from 5 and 3 years back. Crisil has seen a positive growth rate. CAD has also seen a positive single digit growth rate in its sales. ICRA's growth in the recent 3 years has seen a slight degrowth of around 1.3% compared to the last 5 years where it was growing at the lowest speed at around 3% compounded over the last 5 years. In terms of return on equity, both CAD rating and Crisil have generated about 20% of profits on the shareholders' money in 2019. And if you look at the averages of last 5 and 3 years, that too has been about 25% for both CAD ratings and Crisil. ICRA is generating around 15, slightly above 15%, which is my benchmark. In terms of return on capital employed for 2019 and then comparing it with 5 and 3 years averages, highest is for Crisil at around slightly above 40%. Even CAD rating over the long-term average period of 5 and 3 years has earned above 40%, and in 2019 it has come down to around 36%. ICRA has also generated about 20% of return on capital employed. So in terms of profitability, all the 3 companies are doing good. But then we have to understand why CAD ratings valuations are so low compared to the other 2 companies. As we proceed down, we'll understand if there are some faults with CAD ratings. Return on assets of the recent 12 months was highest for Crisil at around 28.6%. This is the profit generated on the total assets of the company. CAD rating also has generated a very high return of around 23.6. Compare that with ICRA, which is generating only at around 15.8%. 5 years averages are also very nearby to its recent 12 months returns. Crisil's revenue were around 1.5 times higher than the assets it owned, which is a good value. We want it to be as high as possible. ICRA and CAD ratings asset turnover is below 1 times. That is, the amount of revenue these 2 companies are generating is less than the assets employed into the business. Next, let us look at the 5 years profit after tax value, and against that how much cash it received during these 5 years. Along with that, we'll also compare how much free cash flows are left with these companies. Crisil's last 5 years total profit after tax was around 1,540 crores. Compare that with the ICRA and CARE ratings, which are almost half the size of Crisil. Cash flows were slightly higher for Crisil against the profit declared, whereas ICRA and both CARE have shown a shortfall in the amount of cash they are receiving against the profit declared. So I want the cash flow from operations of the last 5 years to be at least equal to or above the profit after tax value that these companies are declaring. In terms of free cash flow, that is how much of the cash earned from operating activity was invested in the investing activity part and how much was left over to be distributed in the financing activity. Crisil has invested a very low value out of the cash earned in last 5 years into investing part, that is investing in fixed assets, and the balance, which is 1,524 crores, is left free to be used in the financing activity like paying dividend or doing buyback bonus or loan repayment, etc. ICRA and CARE ratings free cash flows are also very nearby to the amount of cash generated through operating activity. So all of these three companies have done good in terms of keeping their free cash flows at a very good level to the operating cash flows. Although ICRA has received less cash compared to the profit it is declaring over the last 5 years period. If you look at the average PAT value, Crisil had earned around 308 crores every year on an average basis. ICRA is earning around 83, whereas CARE rating is generating around 135 crores of profits every year. So comparing these two companies with Crisil, we see Crisil is quite big in terms of the amount of profit it is generating. Also, if we look at the market cap, this is a 10,000 crore company, whereas ICRA and CARE ratings are slightly below 2,000 crores. Net worth wise, Crisil is almost twice the size of CARE rating at 1,100 crores and ICRA at 638 crores of net worth. CARE ratings equity shareholders contribution is around 529 crores. Contingent liability position for all the three companies is very good. These are all below 20%, which is my benchmark. All the three companies are debt free, that is, they are not carrying any debt on their balance sheet. Therefore, the coverage ratios, that is, the interest coverage ratios, would also be very high. Crisil and ICRA's promoters are holding more than 50%. CARE rating promoters needs to be checked, as this could be mostly institutional holding. None of the promoters have pledged any of their shares. The company's debtors to sales position for all the three companies is very comfortable at below 20%, and they're all collecting very quickly from their customers at less than 60 days. Highest collection days is for CARE ratings at 54. Net profit margin for all the three companies is very high. If you look at the CARE ratings, it is earning the highest net profit margin of almost 43% in 2019. ICRA is earning around 31.7 and Crisil at 19.8. Dividend yield is highest for CARE ratings because we have seen a very high drop in its price, and comparing that drop, and if you look at the amount of dividend it paid last year, the yield becomes highest for CARE rating at 7.63%. Crisil is giving around 2.2%. We'll check out few more ratios. How much was the operating cash flow compared to the net profit? We see that in 2019 there was a 29% or almost 30% higher inflows in cash against the net profit declared. ICRA had seen a 23% shortfall in the amount of cash it generated against the net profit declared. CARE rating situation was also same at a shortfall of around 21%. Next, we'll look at the price to OCF, that is, against the current market price, how much cash the company had earned. Crisil is going at around 22.9 times. ICRA is quoting at around 25.6 and CARE rating at 10.7, the lowest multiple. So we want to buy it as low as possible. That is, when the market cap of the company or the price per share of the company is at the lowest multiple compared to the cash it is generating. In terms of market cap to sales or price to sales ratio, again Crisil is going at around 6.2, that is, its market cap is 6.2 times higher than the revenue it is generating in 2019. ICRA is also at around 6.5, and CAR rating valuation wise is at half at what ICRA and Crisil are quoting at. Again, enterprise value to EBITDA ratio, here too we see that compared to the top line operating profit, what is the enterprise value of the company in the market. Enterprise value is different from the market cap that we analyzed earlier. Crisil is going at around 22 and ICRA at around 14.3. We can see that CAR ratings multiples or valuation ratios are very good and very tempting compared to Crisil and ICRA. Crisil has to increase by around 46.5% to come back to its 52-week highest point. ICRA has to go up 52.7% to come back to its 52-week highest point. The highest fall was seen in CAR ratings, and therefore it will have to move up almost 150% to come back to its highest position it reached in the last 52 weeks. Looking at how much it has come back from the low it touched in the last 52 weeks, CAR rating has seen a substantial up move in its price from its lowest point it reached in the last 52 weeks by 67%. So this stock has recovered quite a bit from its low. ICRA has moved up only 10.5% from its lowest, whereas Crisil has gone up by around 34% and still needs to move up around 46% to touch its 52-week highest point. All the three companies would have given a negative return if someone had held these stocks exactly 1 year back, but the lowest drop in the price was for Crisil at only 3.4%, whereas CAR ratings would have broken the portfolio by almost 60% and ICRA by 31%. Finally, let us look at the institutional holding in these companies. In CAR rating, we see a very high foreign institutional holding of 40.8%, and therefore when we earlier analyzed the promoter holding, we saw it to be zero. That is because mostly FIIs are holding huge positions in CAR rating, whereas in Crisil only 5.7% of the shares are being held by FIIs. DIIs are holding around 12%. So if we look at the holding percentage of institutions, it is very less for Crisil and very high for CAR ratings. So most of the big fund houses and institutionals are invested heavily in CAR rating, and this tells us that these fund houses are heavily invested in CAR and ICRA, whereas they have the least holdings in Crisil. Finally, let us look at the cash and cash equivalent holding of these companies. Crisil is holding around 596 crores of cash, ICRA is holding around 518 crores, and CAR ratings cash holding is just 218 crores. So all of these three companies are holding a substantial portion of cash and cash equivalent on their balance sheet. So this completes my peer group analysis. If you have any doubt or question about this particular section of peer group analysis, do let me know in the comment section. Let's move on and analyze the graph and the intrinsic value of the company. Let us look at the technical chart of Crisil. I have relative strength index set up at the bottom of the screen. This is a weekly chart, that is, each candle or each bar is made up of prices of 1 week. My strategy is to buy when both the RSI lines that you see at the bottom, the green and the red one, to be below 35, and one of them, that is the red one, should be below 30. In none of these years both the relative strength index lines have crossed below 35 together, so there was never a buying opportunity, although there were single dips most of the times, almost 3 times. One was on 25th May 2018, then on October 2018, and finally in August 2019. Yet both the lines never came together down below 35. And earlier when we checked out the fundamentals, we saw how high the valuations were in terms of price to book, price to earnings, PG, price to sales, etc. So for me, this company was never a buy up till now. Even today also it is very high at around 46 and 44. So I'll have to wait patiently to enter into this company. It may or may not give me an opportunity, but I'll have to wait, because I don't rush into buying any companies until and unless the RSI gives me an indication to start buying when both the lines are below 35. Also, if it is fundamentally strong and valuation wise I'm getting it cheap, then only I'll buy into the company. Otherwise, I would want to wait patiently to start buying into this company. As of now, on a technical chart, I don't have a buy signal. Let us move on and look at the intrinsic price calculation. If you look at the intrinsic price calculation, I have 4 targets. Highest is 2200 and the lowest is 1500. So we can select the lowest of it to start buying into the company. Although based on the technical chart, I would not start my buying even at this 4th target of 1500 rupees. The current price is 1400, and from the current price to the target 4, it is approximately 7.4% upside. If you take the average of the 4 targets that I have, the average stands at around 1900. So even if we consider from 1407 rupees currently to 1900 rupees, there is an upside gain of around 35. But as I mentioned, I wouldn't start looking at the fundamental intrinsic price projection. I would better wait for the RSI to drop below, both the RSI lines to drop below 35, and then look at the intrinsic price to start buying into the company. But if someone is really interested and likes this company very much and would want to start buying, I can suggest that you can keep a 10% drop. Every 10% drop you can start buying, or a 5% gap. Keeping a 5% gap, you can start buying multiple times, say 10 times or 20 times you can start buying, upside or downside. And then this way you can not look at RSI, and purely based on averaging method you can buy into this company. The company fundamentals are good, but valuation wise it is very expensive, so I would avoid buying currently. So this completes my analysis of Crisil Limited. If you have any doubts, queries, questions, do let me know in the comment section and I would be glad to help. Thank you for watching this video. Dhanyavad. Namaste.
दीवाना बन गया हूँ मैं चाहत में, तू बड़ू रहता